Welcome to the daily update, where I'll go over the action in the market for Friday, January 31st, and we'll see how things look for Monday, February 3rd. Okay, we saw a reversal intraday. We got all the way up to a resistance level, hit that level, turned, started to drift lower, and then news started to come out of the White House that, okay, February 1st, that's Saturday, tariffs are going to be kicking in. There had been some rumors that, well, maybe they'll find some last minute deal to avoid this. And, well, there are these rumors going around, but by that time, the market had reversed after looking pretty positive and went negative and closed near the low for the day. Now, when you take the bigger picture, we're still positive in the short, intermediate, and long term. We're above the 20 period moving average and the 50 and the 200, but we're not trending. And that's why we're seeing a lot of choppiness, and that's bleeding over into the intraday action. It looked like we were getting a nice little trend going at the beginning of the day, and then that reversed. And so we're seeing kind of waffling, chopping around right now. And the ADX is picking that up, the trend indicator that we use. And we're still not trending, but we're still positive though. All right, let's go back and talk about what happened. We had a gap higher open. There were good earnings from Apple. It was up over 3% the last time I checked before the market opened. It ended up being up 4%, only to close down on the day. And the futures were looking good. Europe was looking pretty good. And so we had a gap higher open at R1 at 6,096. We're dealing with that 6,100 level, and we're just 4 points below it with the pivot point there. And then prices climbed up to R2 at 61.21. Okay. And then that's when everything switched because setting this high at 61.21 was the intraday high. That's why I really recommend if you have charting software, or I do update this on the YouTube community tab. I post a pivot point chart that applies for the whole month, but then I update it every day with that day's bar. And then I also post an intraday based on 10 minutes, and I found those to be the most effective. You can do different time frames. I found the 10-minute to be really good. And that's the chart that I show here, and that's the chart that I follow while the market is open. So we hit that point, and that was the high right there. Then these tariff concerns, plus we're dealing with some other things under the surface too with our smart money indicators. They were getting a little toppy there. Is this the beginning of a more meaningful pullback? Or is this kind of like last Monday where the market freaked out and then quickly that became old news really fast and we went on and ended up recovering from that. But these concerns about the tariffs, it led to a reversal. Now, we were seeing something technically develop, and you'll find that a lot when you use technical analysis. Something critical is happening on the charts, and then boom, some kind of news comes out. And that can either be positive or negative. We'll hit a support level or a resistance level. News comes out, boom, and things start to shift. It's amazing how this often works really close together. Then we fell below R1. We got below the unchanged level. So then we went negative. We went down below the daily pivot at 6,062. We found support again at another pivot point at S1, 6,037. And we closed just about at that level, just a little bit off of the intraday low. We were down 0.5% on above average volume. And as I said, we're still positive in the short, intermediate, and long term. But we took a bit of a hit. It was looking like maybe something more positive was starting to develop. Well, it's going to have to wait till next week now if that ends up being what does develop. We did get an inflation report in Friday's session, core PCE. That's what the Fed really likes to look at. I'll be going over that. Interest rates went back up as we were going down. We were actually getting down to that 4.5% level with the 10-year yield. And then everything started to shift, and now interest rates went back up. So it was kind of disappointing in that regard. And a lot of this has to do, you could say geopolitically, but really it's domestic within the US, but it impacts China, Mexico, Canada, and these tariffs are supposed to kick in. So we'll see what the reaction is Sunday afternoon or evening when the futures start to open. And we'll see, are they going to gap lower? Are they going to be flat? Is something positive going to happen and we gap higher? That's what I do. And this is based on West Coast time. That's afternoon. East Coast time, it's about 6 p.m. That's when the futures open on Sunday. And that's when I start watching things just to see, because then we start rotating around the globe with New Zealand, Asia. We drift over into Europe and then finally into America. And they want to keep the futures trading all the time during those different market hours. So it can give us a pretty good gauge of what's actually happening. All right, now some comments. The intraday reversal, it went alongside the White House confirming that 25% tariffs for Canada, Mexico, and a 10% tariff for China will begin February 1st. That's Saturday. And the basis for the tariff actions were tied to immigration, trade deficit on the US side, and just the fact that we bring in more stuff than we send out. And then fentanyl, which is a very dangerous drug that has really hurt a lot of people and killed a lot of people. There were hints that behind the scenes there were negotiations taking place that they might either pare these tariffs down or, okay, let's delay it for a little bit. But those were just rumors. The market really didn't react to that. We still closed near the worst levels of the day. Small caps are still below their 50 period moving average. Of course, they were down on Friday too. And as far as what we're looking at being extreme positive in the short term, the stochastic charts, but there's three different time frames on that chart, and they're all starting to roll over. And we're still looking positive and possibly extreme positive with our short-term oscillator, the slope oscillator. The Chaikin money flow, it came down, but it's still looking rather extreme. And then the Chaikin oscillator, which I'd been warning about, it's now starting to roll over and turn negative. It's dropped below its moving average. And then the mass index, that's one of these kind of outside indicators that I keep an eye on. It's signaling that there may be a reversal happening. Now, again, that could be happening now. We want to watch the other charts to confirm what we're seeing with the mass index. And the current scenario was modified a little bit this past week since the Fed had their meeting. They're still anticipating a soft landing, but they're going to not cut rates for a while. And they're increasing their inflation outlook. The dollar was up on Friday and interest rates were up. We had been down. We were dealing with that 4.5% level. Well, we ended up closing at 4.57%. Sentiment ticked down a couple of notches. We're still neutral. Even 48 was neutral. We're still neutral at 46. And we're still not trending, but we're positive. The green line is above the red line, but we're below 20. We're below the moving average. We're just kind of meandering around right now. And with the down day, our bias is negative, and I've switched our momentum just a mix, just because we're not really trending. We were looking positive, and we are still positive with looking at the daily charts. But to see that reversal is a little bit concerning, and to see our smart money indicators getting extreme and now starting to roll over is we don't know if it's going to stay that way, if this is the beginning of something, or if it's just going to work off and then turn back more positive. All right, we did get personal income. It came in as expected, up 0.4%, up from the 0.3% we saw last time. Personal spending, this kind of bodes well for the economy. They expected it to be up 0.5%. It was up 0.7% and up from the 0.6% that came out in the last report. PCE prices came in as expected, up 0.3%, up from the 0.1% that came out last time. And then the core PCE prices, this is the big inflation component, came in as expected, but higher than last time. The market liked this. It was okay. It had anticipated that this is what the report would say. And that's why we were looking more positive, at least in the early part of the day. And that's another reason why I focus on the close. And then the fourth quarter employment cost index came in as expected, up 0.9%, where last time it was up 0.8%. The Chicago PMI came in at 39.5, lower than the 41.5 they thought, but up from the 36.9 that came out in the previous reading. All right, here is personal income and spending year over year. They're pretty much flatlining right now when you look at this on an annual basis right now, both the income and the spending. The inflation, this is the big thing. It's actually rolling over a little bit when you look at it on a year over year basis, and the market like that. Month over month spending did go up. That shows that the economy is still looking pretty strong there. And then we look at year over year here with the employment costs, where they're going down. You take the blue line, that's the total reading, where it's going down here. And then wages are going down and or benefits are actually going up just a little bit here. And so that this is not necessarily inflationary in this reading. Then we look at the Chicago PMI, which was up more than the reading that we saw last time. All right, then Isabel Net blog charts. This is showing the 4-week average of buybacks and then plotting that with the S&P. When you see a lot of blue up here, that's when the S&P is going up. When you see a lot of red, that means there's not a lot of buybacks going on, and typically the S&P is going down. We have been spending some time going lower here, and so there were no announced buybacks. Well, now that we started going back up again, we saw an increase in the buybacks. And some of that's curtailed because when companies come out with their earnings, they have to go into a blackout period where they can't buy or sell or announce anything either a little bit before or after their earnings report comes out. And then this says the growing influence of technology on market returns reflects significant outpacing of technology profits relative to other industries over the same period. So this is just showing this is world, and you take out world technology here, where we're kind of flatlining. It's really tech that's driving things higher, not only in the US, but also globally. Then our strategists at Goldman Sachs expect the strong pace of earnings growth of the dominant technology companies to continue, but moderate. So looking out, this is what it was for 2023, and then we're starting to come into the earnings here for 2024 and then out to 2025. They still expect them to grow, but not grow as fast as they have been growing before. A key pillar of the stock market rally, forward earnings. And I go over this in the intermarket analysis video that I'll do a little bit later that I post on the weekend. And this is actually looking pretty good right now, but we're still looking expensive, even looking forward for the S&P anyway. And then the smooth US recession probabilities, we have gone up a little bit here. We're above the black line, but when we get above the red line, that's when we're really concerned. And I'll be showing this in the weekly video as well. And then the strength in equities in recent months has reflected higher growth expectations. The cyclicals, these cycle with the economy. In the dark blue here, this is the US, but they've been pulling back as we've been under some pressure lately. And that's really what we're focused on, but we're seeing that same basic trend happening across the world, except for Europe. Europe's just on fire right now in a good kind of way. Hold it. These are emerging markets. It's hard to tell the colors down here at the bottom. But Europe is still doing good anyway. Nominal, that means just the raw number versus real, taking inflation into account. Earnings growth since various dates, with now how much nominal earnings. Okay, I have a bar right here, which how much nominal earnings have outperformed nominal GDP for each growth period since 1935, since 1955, 95, 2005, 2015. It just shows you the different growth rates depending on what date you choose to start with here. Did find some interesting charts on Twitter. This is the Prime Book, US single stocks. And we're seeing a lot of dumping right now. There's an awful lot of selling that's been going on. And then global equity market bubbles going back to 1973. The global energy bubble that happened in the early 70s. And of course, that led to massive gas prices. And then we went into the Japanese bubble. That was from the early 80s. And then they hit their high in 1989 in their stock market. And then it was just in 2024, I believe, relatively recently, when Japan finally surpassed that high. And then we went into the dot-com boom and bust. And after that, resources here. And let's see, then the banks in the EU, they were having some problems there. And now the thing that's really driving things right now are FANG. These are the mega caps: Facebook, Apple, Amazon, Netflix, Google, Nvidia, and then AI is tied into all of that. And that's currently what we're seeing right now. All right, then this is a anticipation of what are the tariffs going to do to rates. And if there's a 25% tariff on Canada and Mexico, then we might get up to this 10% level. 60% tariff on China, 20% on the rest of the world. That could really increase, and again, I like to point out that up until 100 years ago, this is how the federal government made their money. It was then the adoption of the income tax that changed all of that. And this is different. And it could be positive, it could be negative, but it's different than what we have been under for most of all of our lives anyway. And so the market is a little apprehensive about, okay, what's the fallout from that going to be? All right, intraday here. We were looking pretty good there at the start. We gapped up here at R1. We went up to R2. Boom, that was it. And then we just kind of drifted down. And then things started to come out about these tariffs. And that's when we drifted back below R1. We went negative. Went below the daily pivot. We went down to S1 and then closed just a little bit up off of S1. And then intraday, we even went down more because there's when the market closes, and then there's a period of time after that where the market continues to trade. We settled even down more than that as we got ready to shut things down for the weekend. We're still looking good here, even though we're taking a hit with the blue line coming down, the red line is still below. So on an intraday basis, growth is still outperforming value. And we're actually looking okay here. And we gave some back on Friday, but overall, we're still going up when we look at intraday growth to value for the S&P. End of day, everything was down. Growth was down, but down less. It was down less for the mid caps. It was also down, but down less for the small caps. So not much of a change here with our end of day small cap growth to value ratio. Mid cap growth to value actually went up. That's more positive under the surface. Ticked down a little bit, but still positive in the bigger picture with S&P growth to value. And actually went up a little bit. When you look at the growth versus value ETF, we ticked up, but we're still seeing some weakness here and we're still inside the rainbow. The discretionary to staples ratio didn't really take much of a hit there. We ended up falling down with discretionary and staples went down too. And so not a lot of damage was done when you compare the two on a ratio basis. Large cap growth was down 1/3%, but still above its 50-day moving average. We're not trending here and really not seeing that much signs of a change. The ADX is below 20 and continuing to decline below its moving average. That's why I say we're not trending, but we're positive because the green line actually went up a little bit and the red line went down here. So we just still default to the positive side with this chart. Also, still looking positive in the short term, but not really turning up yet. We're still well below 20. We were above average with volume, and sentiment didn't change all that much with the VIX. So, didn't see a real big, and you look at our equity put call ratio charts, they didn't really change all that much either. Well, they did on the 10-day, but they're still going down, which is positive. So not a real big change here with the VIX, not a real big change with the VIX of the VIX, where it did pick up a little bit there. The momentum, even though the MACD could cross over its moving average, it hasn't done so yet. So the momentum for the VIX, at least right now, continues to be down. The skew index is still giving a high reading, but we have been dropping here. And we ticked up with this fear gauge and we ticked up with this other fear gauge. So we saw fear increasing in other areas of the market, not necessarily just in the S&P itself. And here's where we saw a decline on the daily chart of the equity put call ratio. And we are declining here with our 5-day chart. And then this is a longer term look at the 5-day chart. And then the 10-day really dropped off here. So we're still going down. That means a lack of hedging going on currently. And volatility risk premium was pretty much flat. We're still below this band here. Not a real pickup in fear that way either. The advanced decline line, we still saw more new highs than new lows, but a real contraction of the new highs. Not much of an expansion of the new lows. Rolling over a bit here with the 5-day, but we're still going up. Rolling, kind of flattening out now with the 10-day, but it's still going higher. We are dropping off with our advancers decliners over a 10-day period. That creates an oscillator here where we had become very extreme. Now we're starting to go back down, showing a bit more weakness. And we took a bit of a hit with the advanced decline line based on price and volume, but longer term, they're still positive. A bit of a hit here with our advanced decline ratio in the short and intermediate term, but still above zero, so they are positive. This is where we're seeing some things that were giving us a bit of concern. Accumulation distribution, which is a smart money indicator, we were getting kind of far away from the moving average, and now we're starting to roll back over here. And we're starting to roll over with the chicken money flow. We came down with the histogram, and now the red line is starting to turn down. So this is now turning more negative. And the chicken oscillator, which was giving us a very high reading just under this green line, it's now dropped and has also turned negative. So our smart money indicators have now switched over to negative. The vortex, though, we're still going up with the green line and down with the red line. It's actually improving. And not much of a change here with the cumulative advanced decline line based on price and volume for the S&P. And a bit of a decline here with the NYSE advanced decline line where we are still looking fairly healthy. You see these bars here where we're setting, it's kind of loose, but we're setting a period of higher highs and higher lows. So we haven't disrupted this more positive looking bar pattern, at least for right now. And that could always change next week, but right now it's still holding up. And we saw a drop down, but still above the moving average with the cumulative NYSE advanced decline line. Not much of a change with our regular advanced decline line here. And here's the other one, still above the moving average. And this chart was in the wrong place. This is actually longer term positive. We're getting back above the green line with our 10-day average of the highs and lows for the S&P. We had really come down. We're getting a low reading, and we were just inching our way back up. And now we're back above the green line again. So this is positive. And then the common stock based on price on the NYSE, not really much of a change, either based on price or volume. Showing a little bit of a deterioration here with the advanced decline line studies coming down with the NYSE common stock, the S&P, and mid caps, but still above their moving averages, coming back down to the moving average with the small caps. Longer term and a broader picture, we're still looking good here with a broad market look at the 5-day moving average of the highs and lows. We came down, but we're still above zero. And the stocks inside the S&P above their 20-period moving averages, it did decline. We're dropping down a little bit below 70. We like it to be above 70. That shows good momentum. But when it gets above 80, that means maybe we're looking at exhaustion. So we did see a little bit of a hit here with this chart. And here is our study. We're dropping slightly below 70. We're still kind of working off of this. Now, there are times when we pull back and then end up breaking higher. So we'll be watching for that. But this is more short term in focus with what we watch each day. But we also look at the bigger picture at the same time. We declined, but still above 50 with the 50-period moving average study, declined above 50 with the 100, declined and well above 50 with the 200 moving average study. We're above average with volume. Now we have some new pivot points coming into play that will apply to the whole month of February. We're still well above the 50-period moving average here. We declined with the 20, 50, and 200-day moving averages on the S&P. And we're still above the midpoint with the Stochk RSI, but this is also suggesting we're not trending right now. When we start trending either up or down, we tend to get extreme positive or negative readings with this chart. And the same thing is true with the Williams percent R. We were just barely looking extreme. Now we're dropping back down. We're also not looking extreme with the CCI 14 and 20 as the market is just meandering around right now. The stochastics no longer extreme, but coming down in the short term, rolling over a little bit in the intermediate term, still extreme, but crossing below the moving average with the long short-term stochastic. And I say that because it's a further subdivision of the short-term time frame. Declining, but still just a little bit negative here with the force index. The condition of the short-term trend is measured by a double and triple exponential moving average based on 20 periods. We're still not really breaking down below this, and the lines for right now are still going up. And our simple and exponential moving average based on 20 periods, we're still above both for right now. We're still above the midpoint with our standard deviations chart. The balance of power is still going up and it's still positive. And we're still positive here with the go, no go, with the darker blue bars. We're still above the midpoint with our highest high value chart. The TTM squeeze has actually turned to darker blue. This is something we were watching for. When we get up to about this black line, that's when we really pay attention to this. And it's picking up the weakness that we saw on Friday. And this is a longer term look at that same chart. And I put the black line on here just to kind of get some perspective. It's just kind of a coincidence, I guess, that we're showing things more negative right when we got to the black line. We're still positive and going up with the ease of movement, though. Arun, it's on vacation right now, but it's positive. The McClellan oscillator for the S&P did decline, but we're still above zero. So we're going up based on price. But down here, we're rolling over based on volume. We're seeing a negative divergence here. We liked the volume was outpacing price on the upside. That seems to be changing. At least it changed on Friday. We'll see if we're able to get that back and turn it more positive in the upcoming week. We are declining, but still above zero with the NYSE McClellan oscillator, and we're still going up with the summation index based on price and volume. And this was showing us a little bit of hope. We were starting to turn back up with the Swenlin trading oscillator based on price after Thursday. Now we're going down based on price after Friday, and we're actually dropping below zero based on volume. This is negative, but we've been seeing this for a week now. We topped out and started to come down a week ago Friday. Momentum is still positive. The PMO is still going up. We're still going up when you break it out based on price and volume. Coming down with the PMOs that are rising after being extreme. Also coming down, no longer extreme with the buy signals. Going up but flattening out with the PMOs that are above zero. We're still neutral with the Elder's Impulse system. And all these blue bars, that points to the non-trending environment as well. But the parabolic SAR is still positive with the dots underneath. We're rolling over, but still extreme with the slope oscillator, but it is showing some weakness now. That's a short-term oscillator. Rolling over, but not down to the moving average yet with the MACD. This is more short to somewhat intermediate term. So momentum has taken a bit of a hit now, but we're still positive in the short term, intermediate term, and long term. And another momentum oscillator, the Copic curve, continues to be positive, coming down a little bit here with the Sean trend meter after we barely got up into this little darker green area. And we actually went up with the money flow and we're above 50. That's positive, and we're declining, but still above 50 with the ultimate oscillator. Still above the moving average with unbalanced volume. Still above 50 with the RSI 14, that's intermediate term, and the RSI 9, that's short term. This is another signal. This is the mass index, and there's three criteria to this chart. The number one is when we go above the red dash line. Number two is when we go above the blue line. Number three is when we come back down below the red dash line. That has now happened, and we're wondering, is this signaling some kind of a reversal? And the longer we stay in a non-trending environment, the more powerful the move, whether up or down, is likely to be. It's like a spring that you're just winding tighter and tighter. We're still working off of a buy signal with the Pring bottom fisher. That hasn't gone away, at least yet. The condition of the intermediate term trend, we came down, but we're still going up with the blue line and the red line. So not a lot of damage done there, at least yet. And we're still above all the plotted moving averages. So that's why we're positive on the three different time frames. And we didn't show much of a change here. We actually ticked up a little bit with the bullish percent index. So this is still positive. And we didn't see much of a change to a slight advance here with the NYSE bullish percent index. And we're actually going up with the NASDAQ 100 bullish percent index. So not a lot of damage was done here. And this is also something I've been trying to point out. This is longer term. We're hitting the upper end of this trend channel. Could that also be producing longer term overhead resistance? So far, it appears to be so. We're still positive though with the Heiken Ashi, with the open candles. We're still positive with the Kigge chart. We're positive with the Renko chart, and we're positive with the three-line break chart. Long term, kind of chopping around a little bit now, but still positive with the 150 and 200 period moving averages. And we're still positive across the board, even with the decline, because we were up 0.53% on Thursday. We were down 0.5% on Friday. So that's just a 0.03% change. So not enough. It was disappointing. It looked like we were going to really get set to go up. But then we hit that resistance. It was justified by the news that was coming out, and that took things lower. All right, then we are still positive in the short term with bonds based on price. Commodities are negative, as is the dollar in the short term. And we only had one sector that ended up being positive, and that's communication and that's growth. Everything else got hit in Friday's session. It was like a take it all out and shoot it type of a session. And so we saw a lot of blue or green at the beginning, and then kind of some red as the day unfolded here. Let's see, the NASDAQ got above 19.8, above 19.7, then it went above 19.9, then it ended up going all the way back down to 19.6. We had a bearish MACD crossover with the NASDAQ. The S&P got above 6,100, but didn't stay there. And we got above 45,000 with the Dow. It didn't stay there either. Energy had a BPI cross below 50. And still seeing a little bit of a disconnect as the weighted version of the S&P is holding up a bit better than the equal weight version of the S&P. Still neutral with the Dow, with the blue bars. And it was looking not really strong on Friday, but it was trying to go higher. It opened higher, but then it ended up being down 0.75%. And we're coming up, we hit this pivot point here with the NASDAQ. And I know it's hard to see because of the pivot points in here, but this dashed line from January, that was the high that was set on the NASDAQ. And that could be causing some overhead resistance. We're seeing that same pivot point here with the NASDAQ 100. And we're still neutral with the QQQs, with the Elder's Impulse system. The momentum, we're sideways right now, but we're still above the moving average. So we still say the NASDAQ 100 momentum is still positive. And we're still below, we're just chopping sideways with the small caps. They should be just shooting to the moon now. They're not. They're just treading water under their 50-day moving average. Also, a little bit above 50 here with the Russell 2000 small caps. When we look at the RSI, still below. We were trying to get above the 50-day moving average, but that didn't last. And the momentum, though, is still positive. And we're neutral after being positive with the Elder's Impulse system for the small caps. Came down, this could be interesting, came down to the 50-day moving average for the mid caps, and that provided support. Is that going to mean anything? Is that support level even going to hold for the mid caps? Still neutral, though, with the Elder's Impulse system when looking at the mid caps. This is still holding up, even though we were down 0.44%. We're still above the 50-day moving average with the bank ETF. And the Wilshire broad market measure, it was looking to do pretty well, but then ended up closing down, but still above its 50-day moving average. The financial sector was down, just coming off of a really high reading there. Total US stock ETF down a little bit more than 0.5%, but still above its 50-day moving average. The FANG index was actually up 0.29%. Now, some of that probably had, even though Apple closed down, there were other stocks in there that saw some favor of the big mega caps. And we came down to this longer term trend line. We're wondering if we do start to go back up, are we going to hit this upper shorter term trend line? And Apple was down 0.67%. It had been up 4%, but it ended up closing down below its 50-day moving average. We were up 1.3% with Amazon. Google was up over 1.5%, setting an all-time high. Microsoft was virtually unchanged below its 200-day moving average. Meta was up 0.33%, looking pretty good there. Nvidia was down 3.67%, just a little bit under its 200-day moving average. Tesla was up over 1%, above its 50-day moving average. Netflix, kind of chopping sideways here, but up 0.33%, but still coming off of an all-time high. And seeing a little bit of a weakening in the short term and a leveling off in the long term with the correlation between US and world stocks. Oil still dealing more with the lower end of the 70 range, not really seeing any big movements right now. Still in an uptrend with the dollar, and it did go back up into the 108 range. Semiconductors, we're still wondering, can we hold up above this 250 period moving average? We're still right back down into the rainbow and have really been chopping sideways since last summer. And why am I showing oil again? This is Thursday's chart. Okay, and here's the dollar again, in case you forgot what. Oh, here, this is the dollar for Friday. All right, sorry about that. Well, going back up with the 10-year yield, and then I'm watching an intraday chart where every one of these bars is 10 minutes. We're watching that 4.5% level. We got close to it here on Thursday. It looked like we were really going to give it a shot here on Friday, but then as things started to freak out, interest rates went back up. So we came down to the 50-day moving average with the 7 to 10-year bond ETF. And we're keeping an eye on rates in Japan. If they keep going up, that could cause some problems similar to what we saw last summer. So we're just keeping an eye on that. And then looking at the growth to value ratios, still coming back up to the moving average with the Qs to S&P, but we're below a declining moving average. We're above the moving average with discretionary to the S&P, and we're below the moving average comparing large cap growth to large cap value. So the large caps were under the moving average. Mid caps looking pretty good, going down under the moving average with small caps. That's why I'm wondering, is that 50-day moving average going to mean something? Because the mid caps seem to be holding up a little bit better right now. So what's our outlook? We are still positive, but we're not trending. And now you have all these tariff concerns, and I understand there was another plane crash. My goodness. I hope things don't come in threes. Let's just, two is bad enough. One is terrible by itself, but we'll see what develops over the weekend. We've also got all these confirmations going on and all this yelling and screaming and crazy questions that really don't seem to have much to do with anything. Anyway, we're going to be getting the S&P Global Manufacturing PMI, the final reading on Monday. ISM, that's the big one. And that's a pretty influential report. We're also going to get construction spending and then anything geopolitical, reminding us all that there's still a war between Russia and Ukraine. There's still things going on in Israel and throughout the Middle East. And then anything else that might blow up at some point. Here is the economic calendar for the upcoming week. Tuesday is a lighter day, but we're going to be getting lots of job data throughout the week. We're going to get ISM, where we're getting manufacturing on Monday. We're going to get the services or non-manufacturing on Wednesday. These two are big. Then we're going to get initial claims. That's been a big deal lately on Thursday with productivity and unit labor costs coming out. And then the biggie. That's going to be the employment situation report will be coming out on Friday. Here's another look at the upcoming week with the economic calendar. Seasonality. Okay, I'm going to go over this a little bit because we're starting a new month. February. 14 of the last 18 post-presidential election years have followed January's direction. We were up 2.7% for January. So the odds are in our favor, to quote the Hunger Games there. And the January barometer has been correct 83.8% of the time going back to 1950. So it's looking okay, but this is not 100%. There are exceptions to this, and there's even some flat years in there too. The best 6 months started in November, but February is the weakest of the best 6 months. Going back over the last 75 years, we're up 55% of the time, down 45% of the time for February. And then I'll deal with the options expiration when we get closer. And this actually goes later in because February is a shorter month. We're also having the first day on a Saturday. That's going to make options expiration a little bit later because that's always on a Friday, blah, blah, blah. But now, when you look at Monday, that's a pretty positive day, though. At least historically, it has been. The Dow, S&P, and NASDAQ are all positive. All right, now we're focusing more on February. The first half, not great, but not terrible either. The second half is where quite often we run into some problems in February. Small caps just not following this. Here's February now. We should be going up. We're just kind of treading water sideways with the small caps. This is another one put out by Carson where the first half of February can be positive, but quite often from 1950 up to 2023, not last year. This is where we see some weakness going into the latter part of February. And this was updated. I'm going to drop this after this video. I'm going to just delegate it over to the weekly video because this is long term. Depending on what metric you want to use going out through the whole year, this is as of Friday's, actually probably Thursday's close. Looking at all the different ways you can measure a post-election year, whether it's the fifth year of a presidency, the incumbent party loses, that's what happened. And then the aggregate, that's taken everything together, that's the blue area. And then so far, what's happened in 2025. All right, then this is also going to get shoved over to the weekly video probably after this video. When you look at the S&P, we're split down the middle. We're up 9, we're down 9 in 18 post-election years going back to 1950, with the average return of a minus 1.3%. Not a real solid year in a post-election year. All right, the warning signs. This has now switched over to the negative side. We're declining with accumulation distribution after getting far away from the moving average. The Chaikin money flow is turning down, and the Chaikin oscillator has actually turned negative. It's crossed below its moving average and is now declining. And all of these were pretty much giving us an extreme reading. You might not count the Chaikin money flow. We weren't getting a really, really high reading with that one. But the fact that it's turning down with the other two gives us cause for concern. The Swenlin trading oscillator, it was going up based on price. Now it's going down based on price and volume. And the mass index reversal, is that going to play out and actually mean something? Where we still have a fairly healthy list on the positive side. Growth to value is holding up. Our 5 and 10-day equity put call ratios are still going down. That means there's not a lot of hedging. Folks are more positive on the market. We're still positive with the advanced decline lines, but we saw some weakness on Friday. The ease of movement is still positive, and we're declining with the S&P volume when we look at the summation index. That's a bit of a concern. We're not seeing a confirmation there, but we're still looking positive with the S&P McClellan and NYSE McClellan oscillators, and we're still positive with the NYSE summation index. It's the S&P that's giving us a little bit of trouble right now. We're still positive with the momentum, but they're rolling over a little bit, especially in the short term. Parabolic SAR is still positive. We're still looking pretty good here with the bullish percent indexes. The Vortex actually went up. It improved on Friday. It's positive. We're showing some weakness with our moving average studies, but still holding up fairly well. The money flow and the ultimate oscillator are still above 50. The financial sector is still looking good. The momentum for the NASDAQ 100 is weakening and kind of going sideways right now, but it's still positive. So our conclusion, we're positive, but we're not trending. There are these tariff concerns and weakness is starting to come in. Is it going to continue? It looked like maybe after Wednesday, we were seeing some weakness. We were able to take care of that on Thursday. The weakness that we saw on Friday, are we going to be able to take care of that on Monday, or is it going to develop into something more? In the short term, we're also positive but not trending. The intraday reversal, that's disheartening. Okay, when you have a nice positive open and you end up closing down on the day. So we're going to be seeing a lot of our short-term indicators are still above their midpoints. So we're still positive that way. If we start to see them drop below their midpoints, then that would turn things more negative. In the intermediate term, we're still positive, but we're not trending. And we continue to be positive in the long term. Thank you. I really hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.